We have Mark Galasiewski, who's Asian Pacific market analyst at Elliott International, joining us on the line from Georgia. Mark, great to have you on the show. Very good morning to you. What's the sense that you're getting about the vulnerability of equity markets across the globe, especially the emerging market pack?
Emerging markets have had quite a show in the past year. As you may know, we turned bullish on March 23rd of last year, specifically mentioning India in a long-term bull market forecast report. We were forecasting a Sensex 100,000 within 15 years, and we're sticking to that. This is a long-term bull market story, and this is not a time to be trading very heavily. This is a buy-and-hold situation. So in the short term, however, we are looking at a final blast up. There's going to be a good opportunity on the short side, probably within the next few months, but we haven't reached that top yet. So we're looking at perhaps even 20,000 in the Sensex. That's 6,000 in the Nifty. And at that point, we'll look for a retracement of the entire advance since October 2008. Well, as we all know, there is a general correlation between all major markets, stock markets of the world, but there are those that bounce higher than others and those that retrace a smaller percentage of their advances than others. And the emerging market story, which has been on for the past decade, will continue for the next decade. And that means that there's going to be the same volatility, but the emerging markets are going to bounce higher and fall less as a percentage of the total. But our U.S. market analysts are forecasting a top sometime in the near future, and of course that would probably correspond somewhere within the same time period that I'm looking at a top for the Sensex, for example. But again, each market is going to do what they're going to do in the short term, and so in general, we make a distinction between emerging markets, which bottomed in 2008, and those that bottomed, and the advanced economy markets, which bottomed in 2009. From an Elliott wave perspective, there's a great distinction between those, and that is simply those that bottomed in 2008 declined in 3 waves within a larger advancing bull market pattern. Those fell in 5 waves to the March 2009 low, fell impulsively, and that means that they will fall to new lows in the future. But when that pullback and those new lows occur in the developed markets of the world, by that point, the emerging markets should be so far advanced that the pullback will not threaten their 2008 lows. Right. In fact, we think this market is well in full swing. Again, a long-term bull market story for the emerging markets in Asia and in India in particular. Right. And when you have a range, that just means you've had a sideways correction. That's all. And within the next 7 days, I'll say we have a bottom in India. And in the next 30 days, I think we're headed much higher, certainly to new rally highs. Whether we reach 6,000 in the next 30 days, I think is doubtful. But I think I can give you 5,500. I would say, again, the next 3 months is difficult to say, but I would say that the next year it's very possible that we will have made no net progress within the next several months. So again, we're looking at a top, perhaps up around the 5,750 to 6,000 range, and then after that, not much progress for a while, because again, this is simply how markets work. When you've had a large advance, you've got to have a correction at some point. Well, again, we are very strong, or very long and strong, the U.S. dollar for the foreseeable future, which is the next few years, perhaps. And again, and the reason for that is because you had a decline. The dollar weakened for 8 years, from 2001 to 2008, and so you're going to have a retracement of that rally that's going to last a little more than it hasn't even been 2 years so far. So we're going to wait until we see a normal percentage and a normal time retracement of that decline. And so far we've had one impulse wave up, which means that there are plenty more to come in the future.